So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions.
Hello, everybody, and welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe that the key to scaling and compounding your wealth in life starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth in life so you can give more or all of it away to help MVPs. My name is Brett Swarts. Each episode, we're joined by the top entrepreneurs, millionaires, or billionaires, and they share their secrets, insights, and wisdom with us so we can all level up and accelerate to more impact. Hey, I'm excited about our next guest. He's out of the Pasadena, California area. He's the founder of Wealth Arch Investment Services there in Pasadena, where he helps high net worth individuals and couples build wealth through value investing and personalized financial planning. With more than 2 decades of hands-on experience and a prestigious CFA designation, he blends the timeless principles of Warren Buffett with the modern behavioral finance to help clients achieve financial independence and so much more. Please welcome to the show, Mr. Earl Jordan. Earl, how are we doing?
Good. How are you, Brett?
Doing great. I'm grateful to have you on the show. For our listeners to get to know you for the first time, would you give us just a little bit more about your story and your current focus?
Yes. So there are 2 parts to my story. The first part was when I was growing up in the Philippines, and then the second part was when I moved to the US. So the first part is all about dreaming big, having an entrepreneurial mindset, and saving money. So as early as first grade, I was going around the school looking for recycling bottles and turn them in for the recycling credit so that I can get myself a yummy, delicious Filipino barbecue skewer. And then in second grade, I would sell all sorts of snappable bracelets in different colors and different designs. And then as I grew older to high school and college, I would sell CDs, cell phones, concert tickets, fireworks, and so on and so forth. So my focus was just saving a lot of money. And then one day, I turned on the CNBC channel, and I saw these things going up and down. And I thought to myself, I'm good at games. I'm excellent at math. I won a silver medal when I was in 7th grade, in a national competition. And I said, I can crack this and I can figure this out. And since then, my plan was to go and move to the US and hopefully become a portfolio manager one day. And so the second part of my story was in 2001, I moved to the US. And this is all about hard work, determination, and sacrifice. I started working at a Nordstrom warehouse doing data entry, despite graduating on the dean's list, despite going to one of the best business schools in the country, having the toughest course in that school. I had to start from the ground up. And I worked just getting minimum wage at that Nordstrom warehouse. But obviously that wasn't enough to make a living. And so I had to work and find another job. And so I moved on to a real estate appraisal company. And even then, with a bump up from $7 an hour, $6.75 to $10, that still wasn't enough. And so I had to work a second job at Bank of America as a credit card collector. And that's not, one of the easiest jobs that you can imagine. But I actually made it, quite fun by just being nice to people. And because I was nice and everybody else at Bank of America was either lying or pushy or being aggressive, customers wanted to talk to me, and it was easy for me to collect their money. So I did that for more than a year. I drove from a city called Rancho Cucamonga to Pomona and then to Pasadena, back and forth for those 2 jobs for a little over a year. And sometimes, because I was just so dang tired, I would be falling asleep in the car, and I'd have to kind of like shout and sing loudly just to keep myself awake. And eventually I got a job at American Express Financial Advisors. And to my surprise, when I first came in working in the industry, is that there's very little training that you get. And it's mostly about just trying to sell people and get the commission. And so I was kind of disillusioned by that. And then I moved to Bank of America Investments in a non-sales role, supporting the top 2 financial advisors in the Inland Empire region. And after some time, they entrusted me investing their clients' money in the stock portion of their clients' portfolios. And when I was there, our stock portion of the portfolios did better than the in-house department dedicated to just stock investing. I studied for a CFA designation, which stands for Chartered Financial Analyst, which is the most prestigious designation in the financial industry. Then I moved to the Capital Group. They own the American funds. And at that time, when I worked for them starting in 2007, they were about the 3rd or 4th largest investment firm in the world. And I carved my own role in that company. I was kind of the liaison between the investment group and the administration group. And so I would study and read up on all the financial analyst reports. I'd be on the conference calls. And then through that, and talking to portfolio managers, analysts, and through that, if one of our accounts, which are billions of dollars, had like a $100 million deposit, then they would use my notes as to what stocks to buy and sell. So during that time, it was all about lots of learning. And I was still working like about 80 hours a week and commuting 1.5 hours, every day at the very minimum. And in 2008, I had the lucky or courage to invest in 3 stocks when the financial crisis was happening. I invested in Wells Fargo, American Express, and U.S. Bancorp. I put 25% each of my net worth into those 3 stocks. And of course, as you can imagine, they all recovered from the financial crisis very well. There were multiples of themselves after I invested when I pushed all my chips all in, kind of. And that amount of money allowed me to start my own firm. And here's where I'm at. I'm living my dream thanks to all that hard work and sacrifice.
Amazing. Earl Jordan, everybody. If you want to learn more about him and get connected right now, go to mywealtharch.com, which is what we're going to be talking about today, is building your wealth arch, or building a wealth arch. And so here we go. Earl, first of all, what is a wealth arch, and what is the number 1 secret to building one?
Yeah. So a wealth arch is about creating a foundation so that your money can grow over time. And that foundation, as you can imagine, it has to be super strong, and it can weather storms, earthquakes, natural disasters, etc. Right? And the foundation of that is to make sure that you're saving money and investing smartly, consistently over time. And there are 2 parts to that. The saving money part. Half of America today has credit card debt. And the first thing that most people should do is to do one of 2 things. One is to curb their spending, or number 2 is to make more money. Ideally, both. Without doing that, you can't invest money. And then the second part of building a great foundation is that when you start investing, you have to think about not just the returns, but also the risk. So as an example, let's say one of your audience members, they want to invest $100,000. If they grow $100,000 to $160,000, that's a 60% return. And let's say they accomplish that in 4 years. That's a fantastic return for most people. And there's a 40% correction in the markets. That $160,000 goes to $96,000. So they would have lost more than what they made. So the key to building a wealth arch is to make sure that when you make money and when you invest, that you don't give it all back at some point in the future because you were doing something that was outside of your risk zone or your comfort zone or your knowledge base.
Okay, got it. That's really practical and straight to the point. So the key thing is creating a foundation that your wealth can grow over time. We're obviously very strong. And then the actual actions are curbing your spending, increasing income, and investing, right? More savings, more investing. And then looking at and just understanding the difference between returns and risk, and then being smart about, essentially diversifying and or reallocating once you have those returns, you're not just giving it all back. Is that a fair summary so far?
Yes.
Okay, great. What's the number 2 secret to building a wealth arch?
Yeah. So the second thing is when you are investing in the markets, you want to do what the opposite of what everyone else is doing. So in other words, if everyone is super excited, you want to be very cautious. And when everyone is scared and panicking, that's when you want to be aggressive. So I have this saying called, the big money is made not when the markets are going up, but when it's going down. So the secret to success is when you see everybody panicking, like what I did in the financial crisis, that's where the best ideas are, because people are overreacting to their emotions. On the flip side, if we go back to 1999 in the dot-com bubble, if you invested in Microsoft in 1999, you would not have made money for 15 years, even though Microsoft's net profits tripled during those 15 years. And the reason for that is that the stock went up to crazy heights. People got super excited. And what happens is that if a stock over-earns in the short term, in the long term, it's going to underperform. So that's why you want to do what the opposite of what most people do.
Okay. Very practical. Again, very interesting. If you invested in Microsoft in 1990 for 15 years, you want to make no money. Fascinating. Okay. So the secret is do the opposite of what everyone else is doing. I think, is it like the Warren Buffett favorite quote, right? Be greedy when everyone else is fearful, and be fearful when everyone else is greedy. So that's probably part of the foundation, right? So got it. So how are you determining, for example, let's bring it into real life, AI, right? This last 12 months, are people overly excited about AI? Is it still early with AI? What's your approach to, NVIDIA or different, key stocks in the AI market?
Yeah, great question. And this ties into one of the lightning round questions that you like to ask, right? So I think what are you most curious about right now is sometimes a question you like to ask. And that is the thing that I'm most curious about is how long will this AI build out last? And the real answer here is that nobody knows. And that's why I'm most curious about it. But what I can tell you is I can tell you how today compares to the internet bubble in some sense, and how it's different. So the similarities to the internet bubble are similar, where there's a lot of companies trying to build AI learning language models, similar to ChatGPT, etc., and they're trying to do it for medicine, for any kind of field that you can think of. The difference between today and the internet bubble is that a lot of internet stocks back then were public. There were stocks listed in the market. Today, a lot of AI companies are not listed in the market, a lot of these AI startups. There will be another similarity that will come across when eventually this AI build out will slow down, which is a lot of these startups will go under. So in the dot-com bubble, 90+% of dot-com stocks went bankrupt. And I think that a lot of AI startups today will also go bankrupt, but there will be winners. And the key thing for investors to try to parse out is which one of these companies will be winners. And if you invest in one of these winners, you're going to be okay. And you mentioned NVIDIA, so I'm going to talk about NVIDIA, but just as a quick disclaimer, this information is provided only for educational purposes, and the views are my own. You guys should consider consulting a qualified advisor before acting on anything I'm about to share. There is risk, and past performance is not indicative of future results. But anyway, so I own NVIDIA for me and my clients. And NVIDIA is different from Microsoft because Microsoft back then, it was trading for 60 times what it was earning, more than 60 times. And NVIDIA today, for this coming fiscal year, it is only expected, its valuation is only about less than 30 times its expected earnings. So in other words, it's half as expensive as Microsoft was in 99. Additionally, I mentioned that Microsoft tripled in 15 years. NVIDIA is expected to quadruple, and the key word is expected. We don't know for sure, but it's expected to quadruple in just 5 years. So that's a very big difference in growth. And then the other thing is that with the AI build out, I think that we are, and this is just my guess, is that we are in the early stages. And the good news is that it doesn't matter which AI learning language model company wins. Most likely, they are going to need and use NVIDIA's AI chips because they are the best in the business. And how good are they? Their upcoming new chip, which is called Rubin, that's going to be launched in probably 6 months, on some metrics is 10 times better than their current generation, which was just launched recently. And that comes from a culture of innovation, of unparalleled dedication and work within the company led by the CEO. Additionally, if you think about China is willing to buy its older generation H200 chips. There's at least 2 million orders that are on hold waiting to go through. So that just tells you how big of a lead NVIDIA has. And that's why I do think that NVIDIA going forward is probably a good investment for me and my clients.
Very well said. Again, everyone's speaking with Earl Jordan. If you want to learn more, you can go to mywealtharch.com. Okay, let's keep going here. What's the next secret to building a strong wealth arch for your investing? We talked about the secret of doing the opposite of what everyone else is doing. We talked about the saving and investing over time, right? Creating a strong financial, foundation of the arch, right? And then, selling and making sense of when things are higher to diversify, to lock in some of your earnings. What's the next kind of secret here to talk about today?
Yeah. So when you're buying something, you want to make sure you have what Warren Buffett likes to call a margin of safety. And that's, in other words, a buffer. So what you want to try to do, just like when you're shopping at a department store, which are, a dying breed these days. But if let's say you wanted to buy a suit, or if you wanted to buy a gown and you see something for 50% off, that's a bargain. In investing, that's what you're trying to do. You're trying to find bargains. And on the flip side, on the risk side, what most people try to do after purchasing an investment is they try to look for evidence that reaffirms their thesis. So, for example, if some of your listeners today also own NVIDIA, they could say, oh, wow, Earl also thinks NVIDIA is great. I feel really good. But you know what? What you guys need to do if you own NVIDIA is to look and listen and read to every single person who thinks NVIDIA is not going to do well. And that way, that's how you protect the wealth that you build. And that's, reinforcing that arch that we talked about earlier.
Okay, so it's inviting and listening to the critics or the other side of the argument of those who think that your position is not going to do well. So you don't get caught in the information bias. Is that a fair summary?
Yes.
And then, of course, look for bargains, right? And I guess this is what you do, right, Earl? You're going to look and assess different investment opportunities, different companies and stocks, and you're going to look for those bargains, and those that are working with you, you're going to encourage to invest in. Is that a fair summary?
Yes.
Okay, excellent. Is there a number 4 secret? We can keep going.
Yeah, for sure. We can definitely keep going. Yeah, so the other thing that you want to do is to make sure that you check yourself from being too overconfident, but on the flip side, you don't want to be too humble either. And it's the same side of the coin, where you have to walk that thin line. If you are not confident enough in your investments, you will potentially exit out just when there's some kind of minor trouble, and you would miss out big time. But on the flip side, if you are overconfident, then you are going to think that, oh, I'm just going to keep betting or investing larger and larger sums in the investments that have worked before. But as you know, the markets change over time. Industries change over time. And newspapers are dinosaurs, right? We talked about the department stores. They're dying. We are now at the advent of AI, and you have to adapt to the new situation. And for example, investors who have been super skeptical or cautious about the AI build out a few years back, they missed out on a lot, right? So you need to change your stripes when the environment changes. But you also have to understand that there are things in the world that don't change, which is that rule number 1, you don't lose money. And rule number 2, don't forget rule number 1. And so if you are investing without that buffer margin of safety that we talked about, that is a recipe for disaster. That's never going to change. If you invest in bargains, you are going to be ahead of the game eventually. So there are things that change and things that don't change, and you just have to be cognizant of that.
Okay, excellent. Let's talk about capital gains tax, right? And some challenges that people have when they want to exit highly appreciated public stock, businesses, commercial real estate, high-end primary homes in Pasadena they've owned for a long time. What have you found the biggest frustration is for your clients, that when they want to exit and diversify, but they don't have a great way to sell a business or sell real estate and be able to diversify into a balanced portfolio with stocks with you, Earl?
Yeah. So I know this ties into what you do, Brett. And so when people have large gains, like some of our clients do in some of our investments, it is definitely a consideration for me to kind of slow down before I decide to sell that stock. And so I would need to see extreme overvaluation before I sell a stock that has appreciated so much just because of that tax hit. And before I do sell something like that, I would make sure that my clients are aware that, hey, we are sitting on this large unrealized gain, and then if we sell it, you will have to pay some taxes on it, but I will let you know, and you're gonna have to plan for it and save up money in order to pay the taxes if we do sell that stock. And so definitely that would be something that my clients would maybe refer to you in terms of what you do for your business, in terms of how they can avoid that pain point.
Yeah, so let's talk about that a little bit, so people aren't curious what we're talking about here. So there are ways to sell either stock or businesses, real estate, Bitcoin, defer the tax. And then what we like to do, our clients like to do, is to be able to diversify that wealth. It's kind of back to your concept, I think, in number 2 or 3, where you said you want to be able to sell and not suffer that 40% loss. Let's say a downturn after you went from 100,000 to 160, now you're at 90,000. You're like, oh shoot, oftentimes people are hesitant to sell their business, their Bitcoin, their real estate, their stock that's highly appreciated because of the tax. And so they hesitate, and they knew they should have sold it, but the tax is so much, and they just hold on, right? And that's a mistake because you shouldn't let the tax tail wag the investment dog. But there's a better way. You can now sell. We use trust, typically what we set up, a trust with an installment sale method that allows you to defer the tax, become a lender, and this trust then can be invested from folks like Earl, work with financial advisors across the country. And now they can diversify that piece of wealth. And so a classic example, we just did a $13 million exit in San Diego, not too far from where you're at, and they were selling a car wash. They built it from scratch. Bought the land for $500,000, $3.5 million into it. So their gain all in, their all in basis is about $4 million, but they sold it for about 13. And see, they also knew that the market was highly appreciated. I mean, interest rates were kind of record lows at the time. Bonus depreciation was still just driving values up, and they knew they didn't want to put it in more real estate. It wasn't the time to do it, right? But most people only know about a 1031 exchange, and so they get stuck, Earl, and they end up, over concentrating in the same asset class in the same location, but they end up overpaying oftentimes, right? And then what's happened? We've seen it. Interest rates now obviously have gone much higher, and these floating rate loans have readjusted. Now we're seeing people lose everything. It's horrible, right? It's sad because they were so smart and so diligent and so focused for X amount of years, and because of that 1031 tax deferral, they thought that was the end all be all. They weren't diversified. They weren't liquid enough. They didn't get out of debt. And so we're a big proponent of using a strategy that we have, a trust with an installment sale, and then working with professionals like yourself, Earl, to get a balanced approach to this, right? And diversify. But the same thing is true for stock or Bitcoin, right? I mean, we're seeing Bitcoin go from, about 130 about the high to about 80, and it's kind of bouncing around. And even NVIDIA stock, there's times you could have got out at a good, solid place. And so what are your thoughts on that? And I'm just curious. I feel like there's a lot of advisors, they don't know, Earl, or they don't prepare their clients in time, and they show up to someone like yourself. 2 weeks, I just sold my business 2 weeks ago, Earl. Now here's the investment, but they could have had an extra 20, 30, 40, 50% more.
Yeah, so part of the journey of building wealth, and I tell this to people, it's to think of things in terms of your long-term after-tax net worth. And there are three components to that. One is long-term, two is after-tax, and three is net worth, right? And definitely on the tax part, that speaks to trying to minimize taxes in however way they can, and through like the Deferred Sales Trust that your company does. The other thing to that part is long-term. So many people just think about, how can I maximize my money in a year or three, and then forget that, I'm taking too much risk, and then they get blindsided, and then they lose more than what they make, just like we talked about. And then the third thing is, in America, a lot of people focus on maximizing income. And that, I think, is the wrong way to do it. Because you can make so much money, but if you spend all of that, guess what? Your net worth is not going anywhere. And so we go back to making sure that you're saving money, and that saving needs to be invested. And after investing it, make sure that you are tax efficient, and just continue compounding over the long term. And that's the secret to building wealth.
Amazing. By the way, if people want to learn more about my service here at Capital Gains Tax Solutions, go to capitalgainstaxsolutions.com. Capitalgainstaxsolutions.com. It needs to be $1 million net proceeds, $1 million gain, a larger transaction to kind of really qualify to make sense of it. Just go to capitalgainstaxsolutions.com. Okay, awesome. We're running out of time. Mr. Earl Jordan, you ready for the lightning round?
Yeah, sure. Let's do it.
All right. Knowing what you know now, if you go back to your 20-year-old self, what's that one golden nugget? Make sure to tell yourself to do.
So in investing, Earl, you have to tell yourself to stop being a math guy. And when stocks of great companies go up, just hang on to them, because they will surprise you on the upside. Don't be itchy on the trigger finger and hit that sell button right away.
Okay, excellent. Great advice. Question number 2, what would you say is the number one book you've recommended or maybe given to someone in the past year?
It would be Richer, Wiser, Happier by William Green.
Okay, perfect. Writing that one down. And the next question, what are you most curious about?
Yes, we talked about that earlier, which is how long would the AI build out last? Because if I knew, then I would be able to optimize my investments.
Yeah, it's really interesting to see what happens in 2026. 2025 was just massive, right, with AI. So this is just, the world's changing so fast. Question number 4, number 1 leadership quote or theme that you strive to live by.
Yeah, I believe in just trying to be kind, to be generous. So my favorite quote would be, we make a living by what we get, but we make a life by what we give. And that's by Winston Churchill.
Beautiful. Love that. Next question. How do you best stay ultra healthy and super disciplined?
I think that you have to take it one moment at a time. And if you let yourself be undisciplined in one moment, that could spill over and become a habit. And so if you every time you just try to avoid eating that one potato chip, you're not going to finish the whole bag.
Excellent. Great advice. Question number 6, maybe the top AI tool that you're using on the daily.
I use Gemini and Perplexity.
Okay. Excellent. One over the other versus, or just a little bit of both to get some balance, or is there one that you use more for some
things? I
things?
definitely do both. And even when you, and the reason for that is when you type stuff in AI, they get stuff wrong all the time. It's like they get the stock price wrong, they get who's playing in a sports game wrong, they get who's in somebody's team lineup wrong. And so you need multiple AIs just to make sure that they check each other out. Sometimes they even get the date wrong. And so it's kind of crazy. So these are the paid models, okay? So people have to be careful just to not blindly trust what AI is spitting out.
Okay, good. Great advice. Really, the last question, we'll wrap up the show here, and it's been just really a pleasure to have you on, Earl, and looking forward to the show being released, because I know it's going to help a lot of people and encourage a lot of people. Amazing story, by the way. And this the heart of our show and our YouTube channel is really practicing stewardship over ownership, and we believe that everything we've been given is a gift from God, and it's given to us to be a blessing and a help to others. Use our unique gifts to help and bless others. And so how do you best keep a mindset of stewardship over ownership and really just stay centered in your values?
I go back to always trying to put myself in people's shoes first. If you operate by that mindset, you will be a steward.
Love it. Earl Jordan, thank you for coming on the show. Thank you again for everything you're doing, and keep helping families create and preserve wealth, build a wealth strong arch, to have a strong foundation to live financially free and financially making an impact. You're a perfect guest for the show with everything you're doing. So just thank you so much. Also want to thank all of our listeners or viewers for viewing or listening to another episode of the Build to Billions podcast. We're also streaming on Capital Gains Tax Solutions podcast and YouTube channels as well. And we're on this journey with you to scale from millions to billions, so we can give more all the way to help MVPs, the most vulnerable people. My name is Brett Swarts, and if I could be of service to you, I would love the opportunity to help you exit well, diversify your wealth with people like Earl Jordan by exiting large Bitcoin businesses or real estate and deferring that capital gains tax. In fact, we wrote a book on it as well, if you want to check it out, with Kevin Harrington from Shark Tank, called Building a Capital Gains Tax Exit Plan. And it's a playbook, and it's my story of learning after the financial crash what we wish we would have known before to be able to exit well, starting mostly with real estate, but we moved into businesses, again, Bitcoin, stock. Go to capitalgainstaxsolutions.com or check out the book on Amazon. Appreciate everyone listening and watching or viewing, and we'll talk to you again real soon. Bye now.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.